Hello everybody, and welcome to my Friday video entitled The Most Undervalued Hypergrowth Stocks in My Coverage Universe. In this video, I'm going to go over 33 stocks and their valuation on an hypergrowth basis with my usual method of valuation that I'll get into. Quick reminder, this video is not the best stocks or the stocks that I like the most. I have started doing a video about the stocks that I like the most that I hope to be publishing on Thursdays going forward. And you can watch this video on the "If I could only buy 10 stocks" question, which stocks would it be? This video is going to be published on Thursday on this channel, and I'll put a link in the description if you want to look at it. Anyways, today's video is the most undervalued, ranking them and figuring out which one is the cheapest stock out of all of the stocks that I follow on the channel. Before I do that, let me give you a reminder of how I evaluate stocks, and feel free to skip to the analysis link in the video. But quickly, if you're new to the channel, what do I do on this channel? I focus on hypergrowth stocks. What that means is that I want my stocks to grow at 30% or more, and growing their revenue, growing their sales. Why do I want 30% or more in sales growth? That's because I want them to double monetary inflation. Inflation is eating returns. There's new dollars being issued every year, I believe at a rate of 15%. If a stock does not get their share of the additional 15% more dollars that are going around each year, that stock is drowning. It is not moving forward. That's why I estimate a nominal return of 15% for a stock, to me, is a real return of 0%. So kind of a very stringent approach to the selection of stocks, and you can see why this would eliminate a lot of traditional big tech stocks like a Google or a Facebook, which would not fit that criteria or barely fit it, such that the real return you get is like 3 or 4% buying a Facebook. So that's the reason why I focused on companies that are more early on. And how do I evaluate these companies? I evaluate these companies based on gross profit, based on enterprise value over gross profit. The reason why I use enterprise value is because I want to punish companies that have a lot of debt. Debt can be very detrimental. Market cap hides debt, and I think it's important to take that debt out of the equation to get the true value of the company. And I use gross profit. Why do I use gross profit and not earnings? That's because for my style, what is relevant is gross profit. I want companies to be optimized for gross profit and gross profit alone. If a company is optimized for earnings, that company to me is too late in its product adoption. The companies that I look at are early on in their product adoption curve. They invest heavily in the adoption of their products in the future, in things like marketing, like R&D. They're earlier in that stage of growth. By the time a company is mature, the revenue growth that I seek of 30% should not exist anymore. It should be very hard to find. And that's a reason for me to sell the stock. I would be sold of the stock. So by the time a lot of these stocks get trading on the P ratio basis, and by the time financial analysts like rate these stocks or say, oh, it's a good P, it's a bad PE, bad PE, by the time this happens, I'll be out of the stock. So that's why I focus on gross profit for the sake of my style of investing. And in my analysis, PE I do not find very useful, not useful at all actually. And let me get started with the spreadsheet. So what are the cheapest stocks in my coverage universe? Well, they have not changed this week. They have not changed. It is HIMS, then it is StoneCo, and then it is Love, roughly the same. StoneCo and Love roughly ex aequo here. They're roughly the same. Now, why do I say these are the cheapest stocks? Well, if you look at my enterprise value over gross profit or over revenue growth metric here, you see, for example, for HIMS, it's a 0.06. So that's good. I want to pay as little as possible. I want the ratio to be as small as possible for each percentage point of growth that I'm getting, right? Revenue growth is written here as a percentage, right? That will be divided by 56. For each percentage point of revenue growth, I want to pay as little as possible. And you may find this equation to be very similar to the PEG ratio for mature companies that Peter Lynch likes so much. But this is my own spin on the PEG ratio for hyper growth stocks. So these are the cheapest stocks in my universe, and I have important positions in HIMS and StoneCo. These two are both the stocks that fit the bill, both in terms of long-term potential and in terms of valuation, for me to own as part of the. If I could only own 10 stocks, which one would these be? These are in my top 10. HIMS and StoneCo are in my top 10 stock in the portfolio. Lovesac is a very tiny position for me, but nonetheless a very, very cheap stock for what you get. I'll get into Lovesac later in the video. As far as the most expensive stocks, there's a lot. I mean, there's more now. There's more expensive stocks now. So I'm sorry to say that I'm out of Nvidia and Shopify. And I used to own these stocks for a long time. And you know, Nvidia sold too early. I think, like a lot of us, it may have been a mistake to sell Nvidia that early. But at this nosebleed valuation, there was no way I was owning Nvidia. I mean, you are literally paying more than 50, almost 100 times more for the growth at Nvidia that you are paying for the growth, let's say, at HIMS or StoneCo. So you're paying up for that growth so much. To me, it's nosebleed. Same for Shopify. I think Shopify is very expensive. May have to do with it's a Canadian stock. The only expensive stock that I still own is the Trade Desk. I believe the Trade Desk has been a great performer. I've had it for a while, and I continue to own the Trade Desk, even though it's seemingly expensive per my spreadsheet. A stock that will soon be in that list is Tesla. If Tesla keeps going up at a 0.99, it will be in that list. But obviously, Tesla is my number one position, and I will not be selling Tesla, even if it gets a little elevated on my enterprise value over gross profit over revenue growth metric. That's okay. So now, let me go through each of the 33 stocks in this coverage universe and tell you a little bit what I think. These are stocks that I've covered in much greater depth in the channel. So if you like the stocks that I talk about here briefly, feel free to subscribe and like the video, and it really helps me out. And I've done full analyses on all of these stocks, and you'll find them in the description. So the first type of stock that I follow on the channel is energy revolution stocks. In there I have Tesla, Enphase, and STEM. Tesla needs no introduction, right? It is the leader in electric vehicles, and they have a lot of emerging products in different categories. I don't have time to get into those right now, but really briefly, Tesla, the adoption of EV is real. It is happening, and we've reached that 5% threshold in the adoption curve. So we're still early on in the adoption. So can that 5% move to, say, a 25% market share at some point? I believe so. I don't see why it would not. Tesla is a very compelling product, especially when you compare it to the competition, like the Ford Mach-E, for example, and we see more and more on the roads. Keep in mind, it doesn't matter whether someone likes the look of Tesla or likes Elon Musk or dislikes Elon Musk. When you have a product that's 10x better, for example, in the case of a Tesla car, or any EV for that matter, but let's use a Tesla for that example, when you pay your tank of gas $70 and you end up paying $7 to $13 worth of electricity for that same mileage, that's a 10x improvement. People are going to make the switch for that type of savings. At least that's the bet that I'm making investing in Tesla. Next stock in the energy revolution stocks is Enphase. Enphase is a similar story as Tesla as far as adoption goes. In the US, you have about 5% roof adoption, 4 to 5% solar residential roofing adoption, solar roofs, right? Photovoltaic roof, about 5%. And in Europe, you have about 10% adoption. Photovoltaics is the cheapest source of energy. I call this the energy independence revolution. In my view, solar panels will be an appliance just like any other that every home will have, and every home will create and generate its own power. As Tony Seba says, I'm a big fan of Tony Seba on this channel. You know, every single home has about 7 to 9 times enough roof space to put solar panels, 7 to 9 times what the home would need. And so Enphase is riding that revolution along with SolarEdge. It is nearly a duopoly. I prefer Enphase because I like the microinverters better. I think it's a better technical solution. Noteworthy to say here is that while Tesla is getting a little expensive for that growth, you're paying up for growth at Tesla. Enphase, I believe, is still very, very inexpensive here. Out of energy revolution stocks, I have two blue chips and I have a new issue or a stock that's a little riskier here. When it comes to the blue chips, Tesla and Enphase is the cheaper blue chip by a mile, right? It's more than twice cheaper than Tesla on a growth basis. How much are you paying up for that growth? STEM is an installer of megapacks for industrial facilities and for utilities. They install megapacks from China, a lot of those, and they install actually Tesla megapacks as well. And it's a company that's growing very, very fast, but the gross margin is very low. And if you buy STEM, you're making the bet that their software, Athena, will take over. And when they install a battery storage system, for example, for a large enterprise, they typically sign a 20-year contract for their software. And their software has the 80% gross margin, which is why this is a long-term hold, but this is a tiny position for me because there's obviously much more risk, and they're both competing and cooperating with Tesla, which I think puts them in a more precarious situation compared to a company like Tesla. But it's nonetheless growing extremely fast at 86%, right? It's riskier, but it grows much faster at 86%. So pretty impressive right here. Let me move on to the healthcare stocks. Let me quickly get Teladoc out of the way. Teladoc, I used to own it. I was very bullish on it. And then they acquired Livongo, and then management showed that it's not very good management in my view. Livongo was a waste of shareholder money. That acquisition did not work out. On the other hand, I think a stock that is much more compelling is HIMSS. HIMSS is a stock that focuses on historically stigmatized condition, even though they're moving to all sorts of condition that require a recurring treatment, right? You got to take a pill every day or every other day, or some sort of a medication every month, or you have to do a special shampoo because you're losing your hair, you want your hair back, you have to use a special shampoo every week. This is what HIMSS is selling. Recurring pharmacy prescription products. It's a mix between an app where you have doctors available, and say you want to have a prescription drug to help you out. You don't get it, right? You don't get it like that. You have to first have a consultation with a medical professional. So you have to wait about 24 hours. You get a consultation with a medical professional on your phone. The medical professional says either yes or no, and they do say no if you don't have the need, right? They're real doctors trying to treat you. And if they say yes, then you can buy your prescription from HIMSS, directly from HIMSS. And HIMSS sells a lot of generic drugs. They also sell brand drugs. And they especially sell their compound pharmacy drugs, which are their custom drugs, and gives them kind of an edge. And so, for example, in the ED space, they have what they call these hard mints that really are very popular and seeing a lot of need in the market. So they have a lot of products that really resonate with customers. And I really like HIMSS. HIMSS is a top 10 position for me. Let me move on to my big data stocks in general. Some of these stocks have been on fire, like MongoDB or Palantir. They've been doing so well recently, so much so that they're getting expensive here. So really quickly, let me go through each of them. Datadog. Datadog is an infrastructure data monitoring software. It looks at all of the logs of all of your system and all of your servers. Datadog is named after the big dog. So if you work in IT, the big dog was always the biggest servers with all of the logs. And Datadog is here to see if there's any issue in your logs. So it is a big data stock. It's I think a little expensive now, but it's not nonetheless a high growth stock that I think has a long-term runway. As far as Snowflake is a data warehousing and data lake stock. What does that mean? That means that instead of storing your data in a database on a server, you're now storing your data in the cloud. So it's a data cloud. They nickname themselves. Their motto is, we are the data cloud. Snowflake is the data cloud. And what do we mean by the data cloud? It allows you to upload all of your data, into the cloud, right? Intangible, and it's got a lot of benefits. One of the benefits is, of course, you can analyze it. You can do your business intelligence much quicker when your data is in the cloud. You can share it more easily, but you can especially share it between enterprises and between partners. So you'll have a distributor and a supplier. If they both use Snowflake, they can get on the network. They can share their data much faster than they would if they had siloed data in servers. Snowflake, I am out of Snowflake because they gave awful guidance. They halved their guidance. This is a stock that 6 months ago was growing in the high 80s, almost 90%, and they halved the guidance out of nowhere. And so I was shocked. I was stunned, and I sold the stock. I want to get back in. I want to get back in if it gets much cheaper. Palantir, I love Palantir. I think Palantir is a great company. I'm one of the few investors out there, I believe, at least on YouTube, that own Palantir for Gotham. I really like Gotham. I think Gotham is the leader in AI for the Western military, whether it's Europe or the US, and also Western institutions. They have the best AI software. They have a shot at becoming a main provider of the US military industrial complex, which would warrant a much greater market cap. That's the reason why I own Palantir. Growth right now, analysts are saying 20% growth within the upcoming 12 months. They've lowered that, but the CEO has long said that he expected 30% annual growth for the next 10 years. So that would obviously make of Palantir a very nice compounder. MongoDB is a NoSQL database. So that means in the data world, SQL is everything. But some engineers don't like SQL and they like NoSQL. And in that case, they can use MongoDB in their software Atlas, and they're doing really well. This has been a surprising stock to own in how well they've done, and I'm happy to own it, even though it is very expensive right now. I would not buy any of these stocks right now. I find them too expensive, but they're old position for me. Moving on to cybersecurity. So as far as cybersecurity, you have Cloudflare. Cloudflare is a DNS for websites. What it is that it's a firewall for a website. It hides the address of the server so that the server cannot get attacked. They have a network of data centers around the world, and when you log in a website that is powered by Cloudflare, all you see is the Cloudflare IP. And you do not see the IP of the website you are visiting, which limits the attack for anybody trying to do a phishing attack or a ransomware attack or a DDoS denial service attack. So very helpful. The problem is a lot of people love net just like I do, and it's expensive. It's much more expensive. I believe the two better stocks in cybersecurity, in my view, is CrowdStrike and Zscaler. I like CrowdStrike the best. CrowdStrike is one of my top 10 stocks because I believe CrowdStrike has much fewer competition with Zscaler. For example, Cloudflare has been trying for a while to compete against Zscaler. I don't see Cloudflare competing against CrowdStrike. The reason for that is because CrowdStrike has an endpoint security software, i.e. an antivirus, and it is powered through AI. It has the biggest network. As soon as one computer somewhere around the world that has CrowdStrike's Falcon software gets infected, CrowdStrike knows about it, updates every single other endpoint security Falcon software, and you get the best security. And I think a lot of companies don't want to go cheap on security. CrowdStrike as a competitor in Sentinel-1, but I do not like Sentinel-1 as well because they do not have the data that CrowdStrike has, in my view. Zscaler is a zero trust security system. So what does zero trust do? It does it, but if CrowdStrike fails, and you have an edge device that gets infected, like a laptop, a laptop. So your laptop gets infected, CrowdStrike failed. Boom, you got a virus on the computer. What Zscaler does is that it prevents that virus from going into the company network and from going into any other computer connected to the network, right? Every single connection is secured individually. That's why we call it zero trust. There is no trust between two devices, even though they're in the same company. So Zscaler is a mitigation software in case your antivirus software, whether it's CrowdStrike or Sentinel-1 or whatever you want to use, in case that fails, Zscaler protects the rest of the network when one device is infected. I see these two as a combo, by the way. Let me move on to my e-commerce stock. Shopify is too expensive. I think that has a lot to do with the fact that it's a Canadian company. Also, Shopify is operating in a more mature market, which is, the United States. And because it's more mature, it's not growing as fast as other stocks in the e-commerce field. Sea Limited is an Asian company in Indonesian, to be specific. They have their website called Shopee. Shopee is very popular in Indonesia. They also have Sea Money, which is very popular. The reason why Sea Limited is not growing as fast, seemingly at 16% here in my spreadsheet, is because they have a declining gaming division called Garena Indonesia. They had a game called Free Fire, which got banned across many places, including India, and so they're still struggling from 1/3 of their division, which is showing negative growth numbers, while the website Shopee is actually on fire and doing very well. My favorite e-commerce stock out of the three is MercadoLibre. MercadoLibre is a top 10 stock for me. It is also the cheapest, as it so happens, and it's the one that grows the fastest and that has the highest gross margin. And MercadoLibre is the Amazon or the Alibaba of Brazil, but they've expanded to more than Brazil. They're in Mexico, they're in Chile, they are in Argentina. And they're native, right? They're native from those regions, and so they know how to operate in those regions much better than, say, an Amazon, who is not native to the region. I'm very impressed by MercadoLibre. This company has been a quality compounder for a long, long while, and I believe it has another decade of growth, and I'm glad to be owning MercadoLibre. Let me move on to the payments. The payments, really briefly, I am staying away right now from Square and DLocal, even though I have purchased them in the past and still have tiny positions. They're both under attack by short sellers, and short sellers can be relentless. If I had to make a choice between DLocal and Square, I would choose Square, because I believe the short seller of DLocal is more serious than the short seller of Square. So short seller of Square made a little bit of bogus accusation in my view. But anyways, Square is under a lot of criticism because of their Cash App and etc. Anyways, point is, I don't want to discuss those two. My favorite in there is StoneCo, STNE, as it's pronounced in Brazil. StoneCo is the Square of Brazil, as I call it. Funny enough, right? It's they do the same thing as Square, but in Brazil, and of course. It's a newer technology that was introduced later in Brazil, and so they're still at the height of their growth, introducing these payment devices that are specifically designed for the Brazilian market, keeping in mind that the population of small retail locations in Brazil is extremely high, and STNE has found a wonderful way to sell their devices through community stores, and that's about 85% of their business. STNE also have a mini QuickBooks business that allows small businesses to do accounting. Either way, this is a dirt cheap stock. So even though it may not have as aspirational of a vision as, say, a Tesla or an Enphase or a HIMS, it is so dirt cheap and it can still achieve a much bigger size than a $4 billion company, considering Square is a $40 billion stock after its tremendous drop. StoneCo has also dropped tremendously in the recent crash. Anyways, to me, high quality company growing really fast at much higher gross margin than, say, a DLocal. Let me move on to my chip stocks. I have sold Nvidia. Nvidia, yes, GPUs are the best. They have the best GPUs. GPUs are needed for AI. You need so many more GPUs than you need CPUs. GPUs have a winning technology. Yes. It's a perfect company. But the stock at this price is a no-go for me, even for me, who's like okay with very high valuation. You know, like a lot of people would say Tesla is nosebleed valuation. To me, Tesla's fine. But at this price, it's way too expensive in my view. AMD is the more value chip maker, and I think it's got a good growth profile. We'll see when the Q1s come, but it's got a very good growth profile. So I like AMD better. And as far as my risk here, my not a blue chip type of stock here is Indie Semiconductors. They focus on providing equipment to a lot of EV automakers that are trying to compete against Tesla. They provide things like LiDAR, things like display systems, etc. Stock growing at more than 100% revenue growth, absolutely outstanding and pretty good gross margin. Therefore, it is pretty cheap in my spreadsheet, but not the cheapest, despite that insanely high growth. Moving on to Pubmatic and The Trade Desk. These are two stocks that I have yet to cover on my channel. The Trade Desk is on the buy side of advertising, i.e. you have a business, you're trying to advertise for your business. Pubmatic is on the publisher side of advertising, the sell side. You have a website with a lot of traffic and you're trying to monetize that traffic. Pubmatic deals with selling that ad space, and the Trade Desk deals with buying that ad space. Both of these companies have been doing really well. Advertising has been going through a revolution for almost 20 years now, since the advent of the internet, and that revolution will keep going. Advertising is the driver of the marketing function. The marketing function is prevalent in every single business. I've owned the Trade Desk for a while. I think the Trade Desk is a fascinating company, very well managed. If I had to pick a stock in ad tech, I would pick Pubmatic over the Trade Desk, even though Pubmatic is almost meaningless at this market cap. It's a very small market cap and a riskier stock, and therefore warrants a different, smaller position sizing. Moving on to my lifestyle stocks. I'm just going to call them lifestyle stocks. It's not new stocks anymore. I'm calling them lifestyle stocks here. So you have Celsius Holdings, Lovesac, and Figs. Celsius Holdings is a beverage that is catching the US by storm. Gen Z millennials love the Celsius beverage. It is an energy drink. Beverages are trendy. I mean, it all depends one's taste. But with each generation comes a different beverage, and it seems like this generation really likes Celsius for some reason. I mean, the growth has been outstanding. We have a partnership with Pepsi that helps them grow. You can see analysts expect 67% revenue growth over the next 4 quarters. The gross margin is extremely high for the beverage space. Much of the cost here is transportation. I like Celsius very much. I sold it at a profit after it ran. I'm looking to get back in, but I want to see it crash. I still find it too expensive in this market. I'm not holding my breath. I don't think I'm going to be able to get it as cheap as I had gotten it back then. Celsius, one problem with me is the Pepsi partnership. I'm always afraid that they get acquired, and if they get acquired, that would kill your returns over the long run, right? The ideal beverage company is one that doesn't get acquired. If it gets acquired, then you can't really reproduce the profits that, say, a Monster beverage had if you follow the stock market. Lovesac. What does Lovesac do? Lovesac sells furniture to Gen Z and to millennials. They have highly productive stores and showrooms, typically in malls or in shopping centers. Very tiny footprint, and what Lovesac does is they have this product called the Sectional, which is a sectional that can be changed as you grow, and you can turn it into a bed and into a love seat and into whatever you want. And they got started also with bean bags, and they still have very popular bean bags. Bean bags being, in my view, a direct competitor to, say, the recliner, which is kind of your classic American chair. Funny that I have a furniture stock in there, right? Isn't it? Because if you watch the news, you hear that real estate is dead, and that's probably why the reason why one of the stock Lovesac is the cheapest out of the three, right? Out of the three that I highlighted earlier in the spreadsheet, that's one of the cheapest, along with STNE and along with HIMS. I don't understand why it's that cheap. People are still gonna buy furniture. I think it's the sell-off is really overdone for Lovesac, and I think their product is resonating with the furniture buying consumer of today, which is the Gen Z, which is the early millennials now. Late millennials probably have their furniture. Who's buying furniture now, right? people in their 20s, and people in their 20s, they don't want, say, a lazy boy recliner. They don't want a bulky recliner. They want things like beanbags, and that's why I believe this stock has a potential to be popular. Figs is a stock that has disappointed me very much. The growth is now too low. I would not touch Figs, even though I was liking the stock. What Figs is trying to do is we are trying to make the scrubs a popular outfit or popular style. They copied the Lululemon playbook and they tried to make scrubs popular, and I am disappointed. They are not doing too well, and that has probably due to with a overhang in healthcare, and a lot of nurses spent a lot of money in 2020, 2021, and now healthcare kind of has this overhang, and I believe Figs is hurt about that. We'll see over the long run, but disappointed in this stock lately, for sure. Then I have a new category which I'm calling the cloud niche category. So you have DigitalOcean and AXON in there. AXON is a little more expensive than DigitalOcean. AXON has quite a bit of a following. The reason why I put AXON into a cloud niche is because of their digital cameras for police officers. They are leading suppliers of body cams for police officers, and of course it's all uploaded into the cloud, and they have this whole evidence management system and this whole cloud system to manage all of the recordings of the police, and therefore it's a semi-secure business because you're selling to government entities, and I don't think the police is going away anytime soon. I don't think they're shutting down the police. I think police is here to stay, and communities will require more and more cameras, right? They will require more and more cameras on their police officers. That's why this is a company that has a lot of growth ahead of it, especially in Europe, and a lot of markets, they have a lot of growth ahead of it. So interesting stock. DigitalOcean is a cloud stock for beginners and for small businesses. It offers similar services to Amazon Web Services, but Amazon Web Services or Microsoft Azure is expensive and caters to big business. DigitalOcean caters to SMBs, right? Small and medium-sized businesses. That's who they cater to. They both have niches in their respective space. These companies are interesting. They're close. That's why I'm not buying any of these right now, because they're not at my 30% minimum threshold for revenue growth, but they're very close, and I am monitoring them. And when they breach that 30%, I would pounce and try to buy the stock when the growth resumes, right? Moving on to Nubank and SoFi. Frankly, these two stocks, it's tough to choose. Lately, I have been preferring Nubank for a lot of reasons. First of all, SoFi has run much harder, and SoFi, I am a little weary about the student loan situation and the market associating SoFi with a student loan company still after 3 years of Anthony Noto trying to say, we're not a student loan company. Well, the market is not hearing, I believe we may see more volatility because of the student loans in SoFi. I still have my full position in SoFi. I'm happy about it, but I've been adding much more to Nubank recently because Nubank does not have that overhang. And both Nubank and SoFi are neobanks. That is, they're banks on your phone, banks that live on your phone. They do not live in the brick and mortar branches of legacy bank. SoFi, i.e. the bank of your phone, focuses on higher-end, higher-income consumers in the United States, and they have more than 5 million members. They call them members, not customers, and they're growing extremely fast. And Nubank is growing even faster because Nubank focuses on Brazil, Mexico, and other Latin America countries where people are actually still heavily unbanked, and they still need a bank. So Nubank is very often the first bank that one ever gets in Latin America. So lately I have preferred Nubank because I like that exposure to a faster growing market, which is emerging market like Nubank where is located, is growing fairly fast. So I've been liking Nubank a little better, but I'd be hard pressed to really say which one I prefer. I mean, because 3 months ago you would have talked to me, I would have preferred SoFi. It all depends on the price, but SoFi has had quite a bit of a run. I think these two stocks go hand in hand. I think they go well together. And my last category is the platforms. As far as the platform goes, we have, and by the way, these are two-party platforms only, i.e. platforms where the platform does not pay for the seller's content, whatever they have to sell, and they also do not pay for acquiring the buyers, because the buyers come to the platform because every single seller is on the platform, and every single seller comes to the platform because every single buyer is on the platform. And the big advantage is that whether it's Airbnb, Etsy, or Fiverr, these three companies, they have nothing to sell. They don't sell anything. They just sell. They just sell the sellers that registered on their platform is what they have to sell, right? So Airbnb has more rooms, more accommodations than all of the hotels in the United States combined. But they haven't paid for any of those rooms, and they don't operate any of those rooms, right? Those rooms are operated by the people who list their homes on Airbnb. And Airbnb also spends next to nothing to acquire customers to come to Airbnb, because customers come to Airbnb because the sellers are signed up on Airbnb. So it creates this virtuous positive loop. Platforms are just a wonderful business model. Out of the three, my preferred one is Airbnb here, both in terms of growth and in terms of valuation. Etsy is another really great company, but I've been disappointed by how stalled this growth is. And I think this may have to do with the fact that fewer people are making crafts at home and selling those crafts. Nonetheless, don't want to undermine what Etsy did. Etsy has created a new world of induced demand that didn't exist out of nowhere, and it is nothing short of stunning. But that stock is very expensive for that level of growth, so I am staying away from Etsy. Same is true for Fiverr. I am staying away from Fiverr because even though it's a two-sided platform for freelance work, right, really inexpensive work, right now, I believe we're seeing a stalling in all of the freelance demand related to the fact that it's not 2020 anymore. And so this is a stock that I'd run a lot in 2020. And of course, it has overhang. And, I'll conclude with this. A few stocks on this spreadsheet still have the overhang from 2020. Like, anything related to healthcare, for example, like Teladoc, right? Like Figs, you could put it in the overhang of 2020. A little bit of e-commerce, there's still overhang going on. And of course, whether it's travel, whether it's remote crafts, or whether it's remote work, you still have a little bit of overhang, and these stocks will stabilize over time. Anyways, I've covered all of these stocks in depth on the channel. Please feel free to look at the description section and see each video. I've done dedicated video on each of these. Some of these multiple dedicated videos. Like if you look at Enphase or Tesla, there's so many videos that I've done on those stocks, or HIMS as well. So anyways, thank you so much for watching. This is not investment advice at all, ever. This is just entertainment. I hope you're entertained. Please like, please subscribe. Appreciate all of your comments. Appreciate your watching. Appreciate your time. Thank you, and have a wonderful day.